Scott Colyer, you were bullish on commodities not too long ago. So what's your view of oil and copper and corn and soy, all those minerals, after the prices have collapsed in recent weeks?
Yes, I look at that more of a washout of the group, and I think you have to look at it as a group. It's not just one commodity, it's not just oil, it's the entire suite of them. Commodities over years and decades and centuries have gone in cycles, and they continue. We tend to have a need for things, and we go out and drill holes and dig it up, and then we have a little bit of an ebb in demand, and all of a sudden everybody's like, well, what are we going to do with all this stuff? And prices go down, and prices collapse, and prices crash. Our point is, wouldn't you rather buy the asset at the low or in the trough of that? Because quite frankly, central banks around the world, they're all up in Wyoming today talking about inflation. How do we create inflation? Inflation is correlated highly to commodity prices. So at a time period where 27 central banks around the world are easing and targeting, trying to create inflation, I don't think I want to put myself, in front of that move. I think I would want to make sure that I was properly aligned, congruent with what they're trying to do. I was taught never to fight the Fed. Not going to start now. It's always worked out best in the past. In addition, we see a lot of insider buying in these companies. Yesterday, Southern Copper was a lot of insider buying. We've seen insider buying in some of the most hated names out there. And insiders, when they take their checkbook out, and when there's fear in the market, and they write checks to buy stock in the open market, I think that's compelling, and I think you have to pay attention to that. Is it a trade that's going to make you feel good tonight, or that you're going to talk about at a cocktail party? Probably not. But in my history, the best trades I've ever done have been those that I couldn't brag about at the cocktail party.
And one of the biggest buyers of commodities has been China in recent years. Clearly, China is seeing dislocation in the market right now. How will China impact U.S. stocks going forward? Clearly, we've established a link.
So I think the way that I think about China is China is now the second largest economy in the world, just overtook Japan. Quite frankly, will overtake the United States probably within the next 5 to 10 years. The Chinese equity markets, which everybody are focused on, which is the Shanghai market, that is the A shares, which quite frankly none of us can buy. Institutions can buy them, but private investors cannot. If you look at the Hang Seng market, that's the large cap Chinese firms that trade in Hong Kong. I would just suggest this. Number one, they are a young market, and it's very small. These things happen when you have markets that are small. They happened to the United States back in the 1920s. Margin lending gets out of hand. But I would suggest to you that the big picture is that the People's Bank of China has lowered interest rates now for the 5th time. They've lowered reserve requirements now for the 3rd time. They are stimulating just like we did. And the way we look at it is their cycle is about to start. Ours isn't about the 7th inning. So quite frankly, we are very bullish of China, and we think that as China regains their momentum, they will also regain the appetite that they have for the commodities we talked about.
All right, so you like commodities, you like China. What else are you buying right now? Because clearly this is a trader's market, and if you want to get in, you can get in maybe the next big sell-off.
Yeah, so
there's opportunities right now.
I think there's a lot of opportunity. We like Europe at this point. Once again, they're in the midst of their own version of asset purchases. That tends to correlate nicely with a bump up in asset prices. We're getting good data out of Europe. We're getting good data out of Germany. And they've been through a rough patch as well, so we're very bullish there. Places that I don't like right now, places that I think there's a lot of downside is in the Treasury market. We're seeing Chinese folks have $3 trillion of foreign reserves and wealth, and right now they're liquidating treasuries and generating liquidity so that they can buy in their own markets. Secondly, I think that as our economy continues to be robust, we saw a revised upward GDP number with 3.7% for the second quarter, and I think that is significant. But as we grow and the demand for credit grows, interest rates go up. That's actually a very good thing, is to have interest rates go up. I don't think the Fed will do anything for the balance of the year, but higher interest rates are indicative of a healthy economy, not a sick economy. So when interest rates go up, bond prices go down. Bond prices are still the highest they've been over the past 100 years or so, because interest rates are lower than they have been over the past 100 years or so. So I don't think I want to own that asset. Quite frankly, I'm not being paid for the risk.
All right. Well, thanks a lot, Scott.
Thank you.
And thank you for watching The Street.